Welcome to Business Funding Mastery, another fantastic video coming your way. This training, we're going to go over the 5 options available for funding in today's post-recession market. And when I talk about recession, obviously I'm referring to 2008, 9, and beyond, and how the funding for businesses has changed from that period on. So we're going to break down the options, the qualifying criteria, everything you need to know about securing funding for your startup business or established business. First thing you need to understand when looking at financing for your startup or existing business in today's world is where business finance has come from. Now, in the early 2000s, there was a massive push by politicians and government officials to loosen the requirements for the purchase of a home, and suddenly there were new home loan products that didn't need proof of income. Practically anybody, if you could breathe, you could get a loan. And you could buy a house, and a lot of people indeed did take advantage of this. You even had strippers with no verifiable income that would own multiple properties during this time, or just anybody in general who sort of had an off-the-wall income and could really not fully verify it and just kind of state absurd numbers was able to get financing. So with so much money flowing from the housing sector, several industries followed suit and provided easy financing solutions, whether that was home furnishing, auto sales, and soon there was extreme demand for new startup businesses and existing businesses to be able to find money to fuel the growth of their businesses. Everything was very easy. The result was that there was an overall loosening of lending guidelines for businesses as well as for all types of consumer financing in general. And so, in particular, if your business was a couple years old and your personal credit was okay, nothing real negative on it, you could walk into a bank like I did several times and walk out with a $50,000 line of credit without much effort, without any income verification, and also really without any type of collateral at all. So, at that point, we were kind of all asking, well, how long could this bubble last? How long would the easy money continue? And so as banks and SBA relaxed their guidelines, it wasn't even just the banks that loosened their lending criteria. In a lot of cases, it was the SBA, the government's Small Business Administration group and team that managed lending criteria for businesses, and they just made it easier for banks to be able to offer SBA loans. An SBA loan is by nature secured by the SBA. It's not a loan that's given by the SBA, it's given by the banks, but they'll back up a portion of that loan, so if someone defaults on it, the bank's losses are much smaller than they would be. And so that's pretty much how SBA works. And so in this environment from about 2002 to 2007, businesses were able to secure a lot of bank financing, small, medium, large businesses. And then, of course, when things changed and lenders began to see defaults, the Lehman Brothers, big, huge conglomerate, went bankrupt, and other huge banking institutions like Bear Stearns also failed and went bankrupt. And then this extreme fear and the house of cards began to come tumbling to the ground with a thud, and it scared the crap out of every bank shareholder. It scared the entire economy, and at the same time the government had backed a lot of these business loans and housing loans, and so the losses were really just piling up. So understandably, beginning in late 2008, 2009, the lending sectors really started to tighten up significantly. The easy money was absolutely gone, and the credit markets were, as they termed them, frozen. So if you wanted to go in and get a decent-sized credit line or line of credit without 3 years of very profitable business tax returns and a whole bunch of collateral, and even then businesses were getting declined, there was just no way you were going to qualify for a cent at that time. And so that's what happened as the recession kicks in. So, economies are often influenced and built upon extremes. So whereas in the early 2000s, businesses and home buyers that didn't deserve loans were able to get them due to the extreme risk tolerance that lenders and the government had taken on. So now you got the other extreme that begins to happen, and then even solid and very solvent businesses can no longer qualify for business financing. So at this point, the pendulum has swung so far to the other side that the credit markets were frozen. And by the time the credit markets began to thaw, the end result was that the majority of businesses, who were smaller businesses especially, no longer qualified for financing. So now that we kind of have a better understanding of where business finance has come over the last several years, let's look at the funding options that are available today for small businesses. And some of these funding options for businesses are only available to established businesses, and of course some of them are more geared towards startup businesses. But basically it breaks down into 5 different categories. You've got SBA type bank loans and lines of credit, equipment loans. You've got secured term loans. The third option is short-term merchant cash advance, what I term ACH loans, a very popular option over the last several years. It's very expensive. And then you've got alternative business term loans, and then you've got unsecured term loans and unsecured credit lines and credit cards that are usually the best option for startups. So let's break these down and see if we can get to understand these funding options for small businesses just a little bit better. So bank loans, including SBA loans, let's take a look at that option first. Remember, SBA loans are not offered specifically by SBA, but rather by banks, and SBA will back those loans in case someone defaults. So the loan types available from banks are generally a term loan, a commercial real estate loan, a line of credit, equipment loan, and each of these are generally offered, again, through the SBA loan products. And SBA has 3 different types of loans: the 7A loan, the 504 loan, and the SBA Express, which we'll break down in the next few slides here. But SBA loans, like I said, not gotten directly from SBA, instead issued by these banks and in some cases local credit unions. So what that means is basically every bank pretty much ends up offering the same product. It's the same SBA loan, and so if you're looking for different products at different banks and credit unions, they are all very similar because almost all of them don't want to offer their own loan. They want to offer an SBA backed loan because they are usually guaranteed 75 to 80% of that loan will be insured by the SBA program. So if a business gets that loan for $100,000, $75,000 to $80,000 of that loan is going to be backed up by the SBA. Therefore, the bank takes on much less risk and is supposed to have some sort of encouragement by SBA to offer those loans. So remember, the SBA nearly went bankrupt during the recession due to defaults, so they're in no hurry to lower or loosen underwriting guidelines. And since the recession happened, they really have done very little to loosen those lending guidelines. And with the implementation of the Dodd-Frank Act, unfortunately, it's just very difficult for smaller businesses. And if your business is doing less than $5 million a year in revenues and you're trying to get an SBA loan, it can be a very long, frustrating process. You can spend months and still not qualify for the loan that you're looking for. So let me tell you a real-life story of one of my clients who should have easily gotten an SBA loan. This gentleman's name was Edwin. Very successful business owner in the San Diego area, had owned a gas station and convenience store for a couple decades, and his business was doing a decent amount of money. I mean, it was doing $5-6 million a year in annual sales. It was profitable every single year. It had collateral available in terms of the business, the property, the equipment, the inventory, everything that the business had that made it attractive, or should have made it attractive, to lenders, and especially for an SBA loan. Because if Edwin and his business defaulted on the loan, he was only looking for a couple $1 million on the loan, and yet this business and the property was easily worth $4 million. So had he defaulted, the lender could have taken the property back and sold it, and even sold it at a discount, and still not only gotten their money back, but a whole bunch more than that. So we went through the SBA process, and I guided him to the right lender, the right loan, to be able to get that done. And literally 10 months later, yes, I said that right, 10 months later, after supplying easily 1,000+ pages of documentation, SBA officially declined the deal, saying that for whatever unknown reason, the property was going to be deemed ineligible. They just didn't feel comfortable enough about it. And it was just absolutely unbelievably frustrating for him and for us trying to help him to go through that entire process and get a no. And that's kind of how working with banks and SBA loans go. It's never done until the money's in your checking account, I promise you. Now, fortunately, we were still able to find a decent loan for Edwin, an alternative funding solution. And in any case, that should give you an idea of how difficult an SBA loan is to secure when you have a deal that makes so much sense. There's no risk really for the lender, and yet it's a systematic thing. If the system spits out a no, and it can take months to find out if you have a yes or a no, then there's just nothing you can do about it. That said, there are still SBA loans that do get done, and they are very attractive loan options with low interest rates, longer terms, which mean lower monthly payments. So it's obviously an attractive loan. That's why a lot of people try to get it, but you need to understand right away whether you're going to qualify for that loan or not so that you don't waste all your time. So let's look at the qualifications for an SBA or bank loan for a startup business to begin with. Now, if you've got a new or startup business, the qualifications for SBA are very, very difficult. Let's say you need $80,000 to start a new restaurant business, equipment, kitchen stuff, inventory, etc. Now, first and foremost, a new business has no proven financials, right? So the new business can't guarantee or give anything for the lender to hang their hat on to feel like they're going to be successful and pay the loan back. Now, one of my clients was one of the few who actually was able to qualify for a bank SBA startup loan, and here's what he had to give up in order to get that. Okay, first of all, he had a 401k with a previous job with a $100,000 balance in it, so he actually had to pledge that entire retirement account as collateral and to be able to get the loan. The bank still required 3 years of personal tax returns to have proof of current income to be used to make future payments on the loan, and they took his entire 401k as collateral. On top of all that, they also used as collateral the equipment, and that was basically the only thing he could use the loan for. Even though it was an SBA 7A loan, which can be used for startup and for working capital, all of it went towards the equipment for the business. So it was basically double collateralized, right? They had his 401k and they had the equipment, so they were double protected. And then even after he got that loan, again, it could only go towards equipment. He couldn't use it to pay employees. He couldn't use it to buy food inventory or advertise. Fortunately, we were able to secure some unsecured credit lines for him, and he was able to have the money for marketing, payroll, and inventory. So as much as these nightmares might paint a dire picture, there is an easier, smarter way, but it's important for you to understand all of your options. Don't lose hope, though. Later on, I'm going to introduce some of the easier options for a startup to secure funding, but that is kind of what it takes for an SBA startup loan to happen. So over the years since the recession, I've heard so many prospective clients of mine tell me that before they look at what they actually qualify for, they want to go talk to their banker, and literally in the majority, 95% plus of those instances, the client always comes back to me, and it's what I told them. It's very difficult to qualify for a startup SBA bank loan unless you have a lot of collateral that can be taken, whether that's a piece of real estate with significant equity, a 401k that you can put up as collateral. If you don't have those items, getting an SBA startup loan is not going to be easy at all. So we kind of covered the bank options for a startup, and even though SBA and bank loan options are few and far between, worry not, there are several startup funding options that we will cover later on in this video, so stay tuned. Now let's move on to, well, what if you're an established business? You know, what are your options as an established business? Well, there are more options for an established business. Besides needing a good personal credit and a decent business credit score and also collateral, you're generally, when you're an established business, you're going to need 3 years or at least 2 of very profitable business tax returns. Now that doesn't mean sales or revenues, it means profitable tax returns. So let's say, for example, your business makes $3 million per year and you write off all of your allowable expenses and tax deductions and show on page 1 of your business tax return that your business broke even with no profits. Well, you're generally going to be declined a bank or an SBA loan if you're not showing enough profits. Now, there's certain things that you can add back in from your business tax returns to show profitability. Any owner's compensation, any compensation you take as an owner can be added back in to show a net income. You can add back in any interest that the business paid, any amortization expenses from the purchase of equipment or a property, and also any depreciating an asset like a piece of real estate or equipment. You can add all that back in, and with those items, lenders will take that into account and qualify you for financing. So there's several other factors that banks will take into account, like your industry type. For example, if you are in real estate, construction, finance, brokering, insurance, network marketing, educational and training, private clubs, lobbying, and speculative businesses like oil exploration or real estate speculation, those are going to be deemed ineligible by the bank and SBA because they're higher risk industries with a higher likelihood of failure. So those will not qualify for SBA. And then you've got business credit scores with Dun & Bradstreet, Experian Business, and Equifax Business. They need to be positive. There can't be any tax liens and judgments and collections. In general, it needs to be very clean, and you can actually monitor your business credit by going to nav.com, and nav.com will have some options there for your business credit and be able to tell you, what your Dun & Bradstreet score and Experian Business score and so forth look like. So that said, let's actually look at these small business loans with SBA and see exactly what the programs offer. So the first program you're going to see in this table is we've got the SBA 504 loan, and this is the one that would be used for a startup. A startup business would not qualify for an SBA. Startup actually would qualify for the SBA 7A, not the SBA 504 or the SBA Express. Let's talk about each of these individually. So the SBA 504 is basically a complete collateral asset-based loan, right? So you've got to have equipment or real estate. You can use this loan for construction, and they're generally going to go up to from 10 to 25 years to pay back. The down payments are usually going to be anywhere from 10 to 25%. So if you're buying a piece of equipment for $100,000, probably going to need anywhere from $10,000 to $25,000 down on that. You're going to need, like we talked about, obviously business tax returns that are profitable, and that's for the SBA 504. The SBA 7A can be used for working capital, and the loan amounts are usually $350,000 to $5 million. The 504, by the way, has no maximum. So, you can literally go up to hundreds of millions of dollars if your business is profitable enough to qualify for that. And the SBA 7A can be used for startups. Again, they are going to want collateral a lot of the times with this loan, and they're definitely going to want profitable tax returns or double the collateral if you're a startup business, like in my friend's example there. Then you've got the SBA Express, which is available only for an existing business. And this actually is a slightly unsecured loan. You can get unsecured funding up to $150,000 on an SBA Express loan, so it can be a very useful option if you have the business financials and qualify for that. Let's go on to the next part here. So when it comes to real estate purchases for your business, SBA can be a great solution, but the difficult requirements and the time frame and the odds of wasting a lot of time only to get denied, they are high. In my experience of doing business loans for a decade, I would say 95% of all startup businesses are probably not going to qualify for an SBA loan. And most existing businesses, probably 70-80%, are probably also not going to qualify for an SBA loan because most of them won't show the necessary profits and net income on the page 1 of the business tax return at the bottom where it says net income, and then you can add in interest, depreciation, and owner's compensation. It's usually not enough to cover the business expenses, the new loan payment, plus your personal expenses. So for the majority of entrepreneurs, especially newer ones, bank or SBA loans are usually not your best option. They certainly can be if you've got a lot of collateral. real estate with equity owned free and clear, some expensive equipment that's newer is going to help you qualify, and obviously a 401k or IRA. Let's look at the next type of loan program that's available, and that's secured term loans. So secured term loans come in a few different varieties. They're all very similar. The basis is that you have to have some type of asset that you can use as collateral. So what type of assets? Well, you've got homes and properties that you can get home equity lines of credit with. You've got vehicles on cars with no debt. Could also be an RV, could be a boat that you can get a loan on those if you own them free and clear. And then obviously equipment and IRAs and 401ks are other assets that you can get secured loans with. Now Helocs are great. They have great flexibility. Vehicle loans can be effective, and the IRAs and 401ks from a previous job are good too. If it's an IRA from a current job or 401k from a current job, then that's not going to work because your employer won't let that get tied up as they're putting money into it for you. So let's break these down a little bit. So the HELOC, standing for home equity line of credit, it's usually a second mortgage on your home. It can also be a first. It can be on an investment property or your residence that you live in. Since it's a line of credit, you can typically pull money off of the credit line and use it however you wish. Now, since it's a credit line that's secured by the equity in your home, the rate and monthly payment are always going to be lower on a secured loan versus unsecured. If it's secured, the lender can take that back if you default. They've got security there. If it's unsecured, it's going to be higher interest because there's no collateral for them to use and get back their money, right? So a HELOC has great flexibility, and since you're able to use it and pay it down and use it over and over again, now your home's going to need to have sufficient equity, and the best option that I've seen over the years to secure a HELOC is almost always with your local bank or credit union where you bank at. They're going to be more motivated, they have a relationship with you, and they love to offer home equity lines of credit. Makes them very happy. So that's probably your best option to go for that type of loan. Vehicle and auto loans are another good tool to use. Now, unlike a HELOC, because they're often worth less than a home, the best way to utilize a vehicle loan is you need to own the vehicle free and clear. If you've got debt on it, you might be able to refinance it and get some money back out of it, and your bank or credit union may give you a loan, above and beyond that. But let's say your car is worth $10,000. You can probably get a loan amount up to $8,000, $9,000, even $10,000 with some credit unions and banks. And they might have some restrictions in how far they'll go with the value, but usually they'll come up pretty close to the current market value, of your vehicle. Obviously, IRAs are a great tool as long as they are not with your current employer. You can get a loan on an IRA. You can also self-direct it and use the money and not have to pay any taxes on it, which can be a solid option too. So how do you qualify for these secured loans? Well, in order to qualify for a HELOC vehicle loan, you're going to need your last two pay stubs, usually last year's W-2, to verify your income. And if you're self-employed, you'll need your last 2 years of business and personal tax returns and a year-to-date profit and loss. You're also going to need enough income to cover those payments and have money left over for living expenses. So the cool thing about getting a loan on your IRA or 401k is that you actually don't even need to have any income that's verifiable because it's completely backed up and secured by the 401k. So to get a loan on your IRA or 401k, typically it cannot come from a retirement account that you currently have your job with. It's got to be a previous job. And anyway, IRAs from and 401ks, again, a very useful way to get financing to get your business going. Let's take a look at an option that's available only for established businesses only. And this has become a really popular option. If you look at business loans online, you'll see a lot of these lenders pop up. And these are merchant cash advance loans. So with banks and SBA loans drying up and being more difficult for a large majority of small business owners, during the recession, a new business loan type was born. And this niche was developed. It's grown exponentially. Incredibly. I mean, there are lenders popping up all the time. It reminds me of subprime mortgage lending back before the recession. It's that type of loan. And these loans are ACH, revenue-based loans. You don't have to show net income on your tax returns. You just need business bank statements or merchant credit card processing statements. So in order to qualify, typically, you're looking at a loan of 6 to 10 months, and really in order to qualify, you just need to have business bank statements and merchant credit card processing statements showing at least $10,000 or more in deposits coming in every single month. So in reality, the vast majority of business daily payment lenders, as I like to call them, typically will offer a 6 to 10 month loan. Yeah. Now we're not talking multiple years. You've got 6 to 10 months to pay this thing back. And the best part is that the interest rate or payment rate, as these lenders like to call it, is typically anywhere from 25 to 40%. So if you calculate an annual APR, it's not uncommon to pay as much as 50% or more annually in total interest on these short-term loans. So to even consider taking one of these loans, you'd have to be in a business where you knew if you got $10,000 that you could turn that into $20,000 within 6 months. If you turn a $10,000 short-term merchant cash advance loan into $20,000 and it cost you, $15,000 for the $10,000 to pay it back, but you made 20 on the money, 20 minus 15 shows that you just made $5,000. That might be worth doing because you wouldn't have made the money without getting that merchant cash advance loan. Now, if your business sales or model change at all, then you could very easily find yourself in a position where you're unable to make the payments. You could be put out to business. So you've got to have a good return on the money to make this type of loan work. So again, these short-term loans are usually paid back Monday through Friday with small payments on regular business banking days. So an actual loan scenario might look like this. So you take out a $25,000 loan. In fact, this is actually what one of my clients got. $25,000 loan, 9-month payback. They had to pay the whole loan back in 9 months. Daily payments Monday through Friday of $181 or almost $4,000 per month. You're going to pay back almost $35,000, so about 37 cents on each dollar borrowed. So pretty costly loan situation, but that's kind of what you're looking at. So in order to qualify, your business must have been around at least a year. In reality, probably 2 years plus is what most lenders are looking for. Loan amounts are decided entirely on your monthly business bank deposits going through your business bank statements. So if you average $20,000 per month in business bank deposits, then you could qualify for a $20,000 loan. Your personal credit doesn't need to be perfect. It can be low. It can be below 600 or around 600. Usually 600 is the lowest that lenders go, even though they'll often say they go as low as 550. For the majority of them, it seems like that's what you're looking at. Now, in terms of specific qualifications above and beyond your business bank statements, it's all about taking care of your business bank accounts. So you can only have a couple negative balance days or non-sufficient fund days where a charge puts you in the negative and you're paying one of those NSF $20, $30, $40 fees. That's one of the big qualifications. They also want to see lots of deposits. So if your $20,000 in monthly deposits comes from 2 or 3 big clients, well, that's high risk for them, because if one of those clients goes away, your income goes down significantly. Whereas if you've got multiple clients, maybe 20 clients paying you each $1,000 a month, then if you lose a couple of clients, it's not a big deal. You're still making good money, and your ability to make the payment is higher in that lender's eyes. So it's all about your business bank account for the first qualification phase. The next one is business type. They want to see that you're in a business that has lower risk. So there are certain restricted or prohibited industries that they don't like. Oddly, they don't like accountants, they don't like attorneys, they don't like any type of car sales. Now, if it's car fix-up or car maintenance, like a Jiffy Lube, not a problem there. They don't like finance, they don't like insurance, real estate, similar high-risk industries that SBA also doesn't like. These guys are even more selective. They love restaurants, they love They love blue collar type businesses, car repair, that type of thing. So you want to be careful with an MCA loan. For existing business owners, you need to be experienced, you need to be confident in your ability to generate a strong return on the loan that you take out. A lot of daily payment loans have actually put businesses out of business since they are so expensive and the payback is so quick. In reality, they're the same loans that the mafia started giving out during the Great Depression in the 1930s. This is where loan sharking came about. They are absolutely legal loans to do. The only difference is they're not going to break your knees if you default. They will put you out of business and garnish your bank accounts and so forth if you do not make payments, though. Let's go on to the next type of loan, personal and business term loans. Now, business term loans are similar to SBA loans, but in many ways, they do not have as stringent of guidelines. So as the internet has expanded lending options significantly with personal loans, it's done the same thing with business loans. There are now several unique lenders that offer up to 5-year terms with competitive rates and a much quicker process than an SBA loan and with a lot less documentation. These lenders will typically offer 5-year terms to established businesses, rates that range from 6% up to 20%, and compare that to an SBA loan that could take several weeks, even months. You realize that technology can expedite the funding process for your business with these types of loans. So let's look at some of the requirements with these types of loans. Now, SBA and bank loans may often require collateral. These alternative online business lenders do not. They do not require collateral for the most part. So qualifying for a business term loan, it requires 2 or 3 years of business and personal tax returns. They need to show enough income on the business tax return to cover your payments. So if you're looking for a $100,000 loan with a monthly payment of $3,500 per month on the loan, then you would need to have an extra $42,000 in net income with your business on your business tax returns. You could also add back in depreciation and interest and amortization, owner compensation, but there's got to be enough money there to cover that new loan payment and leave a buffer. In addition to covering your loan payment on your business loan, you must also show enough income to cover your personal expenses and leave extra money there to cover additional living expenses that don't show up on your personal credit report. Now, these business terms loans, as you can tell, are only for established businesses. They're not going to be for startup, and you need to be at least 2 years old. But they're a great option if you're looking for less hassle and a quicker turnaround and just nearly as good a loan as an SBA loan. So they can be very, very good to work with. The next type of loan that you're going to see out there is a mixture of unsecured term loans and credit lines. As we've reviewed the reality of what options there are that are available for startup businesses, obviously SBA is going to be a difficult route if you're a startup, and you can waste months of time and still get a no and have to pledge all your assets and collateral. If you could do it unsecured, meaning you don't have to pledge all your assets and collateral, obviously that's the way to go, and it's much easier to qualify for these types of credit lines and funding than it is for an SBA. So if you've had a business for a year or two and have average monthly bank deposits of at least $15,000 to $20,000, you can obviously look at those secured short-term merchant cash advance loans, but you better be confident you're going to generate enough money to cover them. So when all is said and done, whether you qualify for a bank or SBA and a short-term daily payment loan, regardless of that, you should still secure these unsecured credit lines for your business. It's going to be very beneficial, and you don't pay on them unless you use them. And heck, when you have them available to you, it's going to give you more options at the end of the day to grow your business, or in case of emergency, break glass. Now you've got some money to tap into, right? So unsecured credit lines, the features of them, the payments are affordable, calculated at just 2% of your balance. So let's say you've got a $50,000 in multiple credit line balances. A monthly payment's going to be around $1,000 with those credit lines. You only take the money you need. You don't have to take all 50 like a regular SBA or term loan often. And you can pay them down and use them over and over for the life of your business, which is a huge benefit. Unlike SBA, no collateral. Unlike all the previous loans we've looked at, you don't need income documentation. They don't need business bank statements. They don't need business tax returns. And the cool thing is with a lot of these unsecured credit lines and cards is you're getting a 0% rate for the first 9 to 15 months and then 8 to 20% in the second year. And again, for unsecured money, that's not bad at all. And the monthly payment's affordable. The business credit lines, if you get unsecured business credit lines, they're not going to report to your personal credit. So that's a big benefit. And funding is usually, within 2 to 4 weeks instead of months for waiting for a no at the bank. The requirements are pretty much all about your personal credit, right? You need to have a 680 plus personal credit score with all 3 credit bureaus. You can find that out by going to creditchecktotal.com and see exactly what your 3 personal credit scores are. They don't want to see public records like judgments. They don't want to see collections or tax liens that aren't paid. And they want to see established credit card history, right? So if you've got at least one credit card or credit line with a $2,500 limit, at least a 1-year history on that account, then you're going to get more funding. If you have an installment loan like a car mortgage that's at least a year or 2 old, that's going to really help you out as well to qualify. Now, another important factor for qualifying, and again, this is all about your personal credit. You don't need all the verifiable income to qualify for these, is credit inquiries. They want to see a low amount of credit inquiries over the past 3 to 6 months. So that's very important that you don't have a lot of credit inquiries the last hard credit pulls the last 9 to 12 months. Again, you'll see on your credit check total report whether you've got those or not. The great thing about the requirements for unsecured credit lines is that it's much easier to qualify for credit lines versus bank, SBA loans, even these merchant cash advance loans, and you can qualify as a startup. So now what do you do if you don't have a 680 credit score? Well, I found it's a lot easier to find someone with a good credit score than it is to find someone to get a bank loan or daily payment loan with, right? So every business owner that's really serious about their business, has a business plan, has proven their business model works, you can find one friend, one family member, bring them aboard to your business, and with their good personal credit, as long as they've got that 680 plus credit, you can add them to your business and qualify for unsecured business and personal credit lines. So just, I keep using this term unsecured, business and personal credit lines. It's different than a traditional bank line of credit where you need obviously 3 years or at least 2 of very profitable business tax returns and so forth, usually some collateral to qualify. These are much easier to qualify for. They have a 0% interest rate that first year, and an unsecured credit line is just that. It's unsecured. And basically, it's really a type of business credit card and personal credit card. And although there's negative connotations that go with business and personal credit cards, really it's different when you're looking at it from a business perspective. If you get a personal credit card and you go spend $5,000 or $10,000 on clothes, on a vacation, that's not going to make you any money. On the other hand, if you use that money for your business that's going to generate a return and new sales and revenues and value in your business, well, that's completely different. You're going to be able to generate money to pay those credit lines, those credit cards down, and it's absolutely the very best option for a startup business to be able to qualify for. So at the end of the day, the only real difference between a traditional line of credit, which 95% of businesses will not qualify for, and unsecured credit lines, is that a traditional line of credit charges you interest from day one. Most of the unsecured credit lines and cards, I recommend charge 0% for the first year. And the second major difference, and the one most people are confused about, is the ability to access cash. And there's actually a lot of ways that you can make business purchases with a card in today's technologically driven world. 95% of businesses will accept payment with a business or personal credit card. Now, some things like payroll and lease rent obviously do require cash, and there are methods to get checks and so forth to access cash off of these unsecured credit cards. And a lot of people are not aware of those options, but there are options to be able to do that. So bottom line, at the end of the day, entrepreneurs should secure as many unsecured credit lines and credit cards as possible Utilize them wisely since they are the most flexible business finance product out there, and more importantly, they are the easiest to qualify for. Clearly, that's an important factor. There's what you want and there's what you qualify for, and at the end of the day, you got to go for what you qualify for, and it's still going to be the solution that your business needs, and so forth. So there you have it. Sorry, I didn't go over this slide. I didn't have the slide on there as I was talking about it. But again, traditional bank lines of credit charge 6 to 18% immediately. Unsecured credit cards are 0% for the first year, and then usually similar rates, about 6 to 19-20% the second year. And again, most businesses, like I said, will accept payment with a card. Those things that don't, you can access cash on those and still do some transfers to keep it at 0% for that first year. So again, the funding options, we've reviewed all 5 of these available options for entrepreneurs. Took a little bit longer, but I didn't want to miss anything, so that you had all of the information. Now that you have the information knowledge, you have a better idea of where you can qualify for funding for your business. These are the most available options for entrepreneurs when it comes to getting money for your business. So hopefully it's been somewhat entertaining. You didn't fall asleep, but at the very least, you can review this over and over again. It's unlikely to change. We'll keep it updated over the next several months and years as new business funding products come available. But there you have it, the 5 funding options for small businesses: SBA bank loans and credit lines, secured term loans like your Heloc, vehicle loans and 401k, the short-term expense and merchant cash advance loans. Take those only if you're very confident to get a quick return on the money. Business term loans, usually unsecured, no collateral required, and unsecured credit lines and credit cards. Obviously, probably the best option for most startup businesses. Hope you've enjoyed it, and on to the next video training we go.